Hello there.
It's December and we're officially a week away from Christmas. Can you believe it? If you're in the UK, that means we can now start complaining about the cold, as if we needed an excuse to complain about the weather. And if we're complaining about the cold, we're turning up the heating, and if you're like me, that means you're keeping an eye on your heating bill, which is not pretty. Thinking about heating bills is making me think about nuclear stocks, and that's why that is this week's theme. So welcome to the episode. Let's talk about nuclear stocks, catch up on our portfolios. I'm the Gentleman Investor. This is Battle 16. Let's invest. As always, we're going to reveal who won last week's battle. We're going to find out how our portfolios have done, and we're going to battle two stocks against each other. Without further delay, let's get underway. Last week saw the S stocks battle against each other. Spotify took on Shopify, and the winner with 3 votes to 1 was Spotify. Let's hope it really turns it up for us. Right, let's take a look at how our portfolios have performed this week. By way of reminder, it's £25 into 3 portfolios, 25 into the Battle Royale, where you tell me which stock to invest in, 25 into the benchmark, where we battle the Battle Royale against the FTSE All World, and finally £25 into the income generator, where we try and make some money to pay out our lucky subscribers every 6 months. So this is how our portfolios have performed over the last 7 days. It's been a little bit miserable. Not as bad as it could be, that's for sure. The UK market down 0.2%, the benchmark up 0.1%, the income generator taking a beating this week, minus 1.2%, and the Battle Royale outperforming everything, up 1.6%. This is what's happened to the stocks in the Battle Royale over the last week. The big movers and shakers. Incredibly, still going up is Tesla, up 12.1% in the last 7 days. That is incredible. I'll show you the overall in a second. Nickel's going strong, still moving up. The big losers this week, YouGov falling almost 5% in a week. That hurts. And the new coffee edition, BRC, down 2.6%. I think that's going to be a volatile one, so we'll keep an eye on that. Here is the Battle Royale in more detail. As you can see, according to Simply Wall Street, it's now a value portfolio with good growth potential. I'll take that. The last 7 days, it's great to see that little discrepancy between how well it's doing in the market. Always very nice to see it in green. We're up to 14 holdings now, and this is what I was talking about with Tesla. Overall, 100% return since we've held it. So it's £25 that we put in is now worth 26, so just over 100%. That is crazy. Not everything is in green, although I'm very happy with the percentage overall of how many are in green to how many are in red. But you can have a look at, say, YouGov, which is now fallen 5% over the last week, allegedly up overall, so I'll take that. Probably our biggest loser is the coffee stock with oh no, I lie, sorry. Soho Triple Point down 7.2% overall, although B&M, the biggest loser, 9.9% down. This is what's happening in the income generator. Very exciting. We're up to double figures. The annual dividend's now up to £10.52. Next payment, £2.06 and £1.88, and then we're going to pay all of that to our lucky subscribers, so that's up to £3.94, up from last week when it was £3.66. So we are getting there. And finally, this is the summary of how everything's going overall. We've now added £350 to our portfolios, and they are worth respectively 397, 368 and 353. So all going along brilliantly. I'd love a little bit more growth from the income generator, as it's only £3 more than we've put in. But I'll still take that, especially considering that's all about what it can pay out, which, as you saw, is up to £10 annually. We're going to keep plugging away at that. Overall growth of 14% is awesome for the Battle Royale, so pumped about that. And 5% for the benchmark is not too shabby either.
3, 2, 1, fight.
Nuclear energy is fascinating and scary, and it takes people much smarter than me to figure out. And as Buffett always says, only invest in what you know, which we definitely stretch to the limit sometimes on this channel. So we're definitely not going to be investing in full-on nuclear companies and all the components and all of that. We're going to invest in companies that support these industries. Let's take a look. So here we have this week's submissions, UK nuclear related stocks. Of course, everybody knows Rolls-Royce, and it is apparently only at a 20 times PE ratio. However, it's got negative growth, and I think that stock's been pretty much tapped out. So, and also, we're just going to look at other stocks just to keep things interesting. And accordingly, it's going to be Centrica, IMI, Renew Holdings, or Speedy Hire. I've already narrowed a few of them, getting rid of Speedy Hire, which is, it's got a 45 times PE ratio, and it does apparently have a massive growth of 72.4%, but its health and past are very, very low. So I don't know how safe that is. And as we know, the first rule of investing is to not lose money. So I'm going to have a look at these three, which are a little bit greener in the past and health departments. As you can see, we've got a 6 times PE ratio, 18 times and 17 times. So all within the bounds of affordability and within the norms for UK stocks. Centrica operates as an integrated energy company, and IMI is an engineering company which works in the design, manufacturing and servicing of engineering products, and Renew Holdings is a contractor in the field of engineering services and building in the United Kingdom. So all kind of ancillary to nuclear per se, not exactly directly nuclear, and that's not necessarily a bad thing. It means we hedge our bets, and any rise in nuclear will hopefully rise with these three. I'm going to immediately get rid of Centrica, which has a negative growth rate, so that scares me a little bit, and that's going to leave us with IMI, which is a PE of 18 but growth of 12, nice and solid, versus 17 and 10. Let's look into those a little bit more. Now that we've narrowed it down, let's take a look at and compare their high-level metrics. Here they are side by side. IMI is the much larger company with a market cap of 4.7 billion versus Renew, which is relatively small with a market cap of 769 million. I've also included their 5-year stock charts, both slowly rising on the whole, Renew taking a little bit of a dip towards the end there in more recent times, but overall relatively steady from both of them. Quickly to highlight, both pay a dividend yield of around 1.5%, Renew slightly higher at 1.89%. Both have large revenues, IMI a little bit bigger at 2.2 billion versus 925, but IMI is the slightly more expensive stock at 19 times the PE ratio and 15 times for Renew. Earnings per share relatively similar. Well, I say that it's actually pretty much double. IMI 0.92 versus 0.55. Not a huge amount to go between these two, that the slight differences are to be expected between the size differences and maturity levels of each of the companies. So I think we'll need to dive under the hood a little bit more before we make our decision. So I'm going to start us off in the first place I always like to look when comparing two stocks that I can't decide between, and that's the valuation. Now, of course, you should do this yourself rather than rely on an online website like Simply Wall Street. However, for illustrative purposes and because I can't calculate it myself, let's take a look here. And for IMI, it is apparently 24.2% undervalued, which is quite a nice little bit. So I would be tempted by this one. And compare that to the estimates for future growth, which in this case is pretty steady. And I'll just quickly highlight they are projecting that this has got a nice future, and the future return on equity is 25.4%. So how do those two figures compare to Renew? Let's take a look. Renew is massive 41.7% undervalued according to Simply Wall Street, so that's a lot more than IMI. However, is its future growth as impressive? We'll just scroll down a little bit. That looks like it's got a nice little jump up, and specifically the little indicator that we want to look at, the future return on equity, 20.7, so not quite as high as IMI, which was 25.4. So better value but less return. It is really difficult to choose between these two stocks. Let's put it to a vote. What do you think? Which one would you invest in? Are there any other nuclear related companies or stocks that we should have thought about? Please let me know in the comments, and thank you so much for watching. I really appreciate it. We'll see you next week for a special Christmas episode.
Goodbye.